Hello students. Yes, in my previous video, I had explained on the different factors that which affects a financial plan. So I have covered five factors under that video. So we'll move further. Fine. Point number six, the factor six. So what does it talk about? Availability of a finance. Now, what does availability of finance talk about? Listen to me carefully. See, the amount of finance which is available to a company, it depends upon the prevailing economic situation, right? See, the easy availability of finance, it brings in the flexibility. You have learned it under the principles of sound financial planning. Always a sound financial planning, it should yield a flexibility where a firm, whenever there is a need under any kind of circumstances given a chance, it should be able to get in a kind of flexibility in the financial planning, for which the difficulty in getting the finance, it always warrants the tighter financial control. As a financial planner, when he is formulating a plan, he should make sure that whether there is a availability of finance, the funds or the capital, the amount what he needs. If he wants 10 lakh rupees, yes, he has made a plan of his capital. Again, what I told, it all depends upon the nature, it all depends upon the size of the company. After that, he must ensure that there is availability of the finance. There can be multiple sources to raise the funds, but it depends upon his nature and the size of the organization. Upon that, he can go ahead with the factor of availability of funds. Again, availability of finance, it plays a vital role in terms of affecting a financial plan. So it is very important for the financial planner to take an ideal decision with respect to the availability of the finance, right? So the next factor what you have is sources of a finance available to the company. Now, what does sources of finance talk about? See, as I told you, there are various sources of finance which is available to a company. See, it can be in form of issuing equity, it can be in form of issuing the debentures, it can be in form of issuing the preference shares, it can be in form of borrowing a loan from the bank or the financial institutions, right? Likewise, you have lots of sources through which you can raise your money, and you can have a capital formation in your organization. So a company, it has to consider the different of the sources of finance which is available to it. A financial planner, first he has to study the market, he has to see what are the different sources that which are available for me. Out of that, how can I raise the funds from different sources? Again, I have told you very clearly, two factors, they play a vital role. One is risk, one is the return. If he's going to raise it from in form of issuing the debentures, what is the risk he has to bear? He has to pay the fixed rate of interest within a given period of time, right? That's the risk. Is he sure that in case if he's going good, if his financially well-being is doing absolutely great, definitely he'll do that. If the company is under loss, do you think he can make it? No. So this is the risk, because debenture is something that's outsiders fund, that is a borrowed fund where it is always under a risk. So he has to consider all those factors, and it may have a choice to decide. You have multiple, out of which a financial planner, he is going to a financial manager, where he's going to take care of things as a treasurer, as a controller, where he takes care of cash management, the credit management, portfolio management, the tax minimization aspect, right? So they will have the choice to decide the sources of funds, and sometimes it has to make the use of only those sources which are available to it. And again, this factor of sources of finance which is available, it is going to affect the financial planning of the firm, right? So the next point, I hope you guys are clear with this. The next point is a cost of a financing. Now, what does cost of financing talk about? Listen. See, the cost of finance of the various sources of finance available to a company, definitely it might differ. So the loans, that expect a lesser rate of interest, whereas equity, what does it do? The equity holders, they expect a higher rate of dividend. See, when you have invested your money, when you have poured your money, it can be, in the business, in a project, or in terms of, purchasing a fixed asset, or it can be, in terms of having, putting in the project itself. As I said, project can be expansion. Yes, expansion, it can be in form of diversification. What do you expect out of it? Of course, a return. Of course, you want to generate an income over the investment what you have made, right? It can be in form of dividend, it can be in form of interest, right? So this talks about the cost of financing. See, the cost of financing is also, like, affected by the expectations of the investors. See, people who have invested in form of equity shares, what do they expect? They always expect higher rate of dividend. If a company has to, give or distribute a portion of its profits in form of dividends, that is higher dividends, what should it have? Right, it should have the profits, sufficient profits in order to make the payment of dividend. And whether it can be like fixed rate of, dividend, or a floating charge, it can be also, right? It can be created on the asset of a company. So to sum up with, a cost of finance, it determines the financial plan which is done by the firm. Again, cost of financing, it affects the financial planning of the firm. All right, so the next point what you have is method of acquisition of assets. Acquisition means, acquisition talks about procurement, the assets of, the procurement of assets. How, in what all ways the assets can be acquired. See, like, the trading concerns, they may survive with minimum or no fixed assets, right? So whereas a manufacturing, trading is where I'm basically talking about the service sectors. There you need not worry about the working capital management as well. But under a manufacturing concern, definitely it requires a fixed assets. Why fixed assets? When I'm telling manufacturing, what does it talk about? You are producing a product, you are coming up with a good, you are manufacturing or producing, right? So what do you want there? You want a plant and machinery over there. That talks about fixed assets. Then apart from that, in order to do that, what do you want? You want a plant layout, I mean to say, you want land and building. And what is land and building? It's a fixed asset. In order to run your operations, you need a plant layout, you need a land and building in order to set up your plant and machinery, right? All these talks about the fixed assets. And the fixed assets, they may be purchased outright as well. See, they may be acquired through the hire purchase. You all know, I guess, what is hire purchase system, where you're going to, hire it, where you're going to buy it, where you are liable to pay the royalties. And leasing can also happen over a period of time. And the way, to which the company intends to acquire its fixed assets, definitely it also affects the financial planning, right? So method of acquisition of assets also plays a vital role, in terms of affecting a financial plan. All right, so next point, what you have is working capital needs. Now what does working capital needs, what does working capital talks about? So working capital talks about the funds what a firm requires in order to run its a day-to-day operations. In order to run the day-to-day operations, the funds what you require, it talks about the working capital management. So the amount of, the working capital required by a company is determined by the credit terms, that are offered to the company by its suppliers, and the terms of, the trade offered by a company to its customers, right? It's vice versa. So no credit from suppliers, it always results in increase in working capital. See, when you're not providing any credit, instantly you are, both the things are happening in the transaction, where a buyer is getting the goods, where the seller is receiving the amount on what he has sold. So what is happening? Immediate cash, the current asset, you are able to maintain the money. So what is happening? You have cash with your hand, which is readily available. What does it do? What will be the impact on the working capital? Of course, it will increase, because cash is something that which you owe, the company owes, right? And vice versa. It's like no credit to the customers, it results in decrease in the need for working capital, right? So the financial planning of the concern, it differs accordingly, right? Always a financial planner should always make, an ideal decision with respect to the working capital needs as well, whether it is a big firm or a small firm, whatever you take, always a working capital, it plays a vital role because you have to run your day to day operations, right? So always a financial planner has to take care of, the daily aspects, that how the funds need to be, spent, and how daily the operation should be managed, and how the factor called liquidity should be attained.